Federal Reserve insider reveals shocking new paradigm shift. His assertion is that if the Fed raises interest rates, it'll add more fuel to the inflationary fire. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over how this system worked prior to the GFC and then after the GFC. But before we get to the whiteboard, I want to go directly to the internet and hear from this Federal Reserve insider in his own words why he thinks the entire system has changed. What you have been led to believe is that lower interest rates actually increase inflation. Higher rates decrease the rate of inflation. And he is saying that now it could be the exact opposite, where if the Fed raises interest rates, inflation will soar higher. Editor, let's go right to the internet. So first of all, who is this Federal Reserve insider, you are probably asking? His name is Joseph Wang. He is someone I've interviewed before on the George Gammon channel for the Rebel Capitalist Show. And he used to run the trading desk at the New York Fed. So what this means is he was actually in charge of quantitative easing. So if anyone understands the plumbing of the banking system, it would be Joseph Wang. His most recent blog post on fedguy.com, this is his website, is titled Inflationary Hikes. A structural change in the plumbing of the banking system has dampened the impact of monetary policy and may even make rate hikes inflationary. Rate hikes now directly increase the asset returns of banks while leaving their funding costs unchanged, effectively encouraging credit creation. This is because banks have shifted their funding structure away from rate-sensitive money market funding to rate-insensitive retail deposit funding. I know a lot of you right now are saying, whoa, George, that was a little over my head. He's using all that esoteric Fed speak, but don't you worry about it. I'm going to explain it to you right now on the whiteboard. So sit down, pour yourself that stiff drink. You're definitely going to need it for step number 3. Just a quick heads up. All right, so let me explain what Joseph is talking about. Above this thick black line, I've got a diagram that represents how the system worked prior to the GFC. Let's go through that. If the Fed wanted the Fed funds rate at, let's say, 2%, and that's the rate at which banks lend to each other overnight, the way they would adjust this up or down is they would either buy or sell treasuries, mortgage-backed securities from the banks themselves. So what are they using to buy those treasuries? Well, they're just creating bank reserves denominated in dollars. Because let's say this is bank A, B, and C. They all have accounts with the Fed. So if the Fed buys a treasury from bank A, then that treasury goes onto the Fed's balance sheet. Technically, they're buying it from bank A, but really that just means that they're crediting bank A's account with the Fed with the additional bank reserves denominated in dollars. So they create enough bank reserves so the system had the amount of liquidity needed to achieve this interest rate. It's basically simple supply and demand. The more bank reserves that were in the system, the lower the interest rate. If the Fed sold treasuries or assets back into the banking system, they're pulling liquidity out or they're reducing the amount of bank reserves. Therefore, if there's less liquidity, if demand stays the same, then interest rates would rise. And this is how the system worked. But let's also think through what would happen on the other side of the commercial bank's balance sheet. We're talking about the asset side right now, which are liabilities of the Fed. But now let's think about the liability side of their balance sheet, and that would be an asset of the average Joe. All of you guys watching this video right now, you have a bank account with Wells Fargo, Chase, maybe Bank of America. That's your asset, those dollars in the account. That's a liability of the commercial bank. So what would happen in the good old days is you'd actually get paid interest. to have your money at the bank. Shocking, I know. Back in the good old days. So in this example, let's say the Fed funds rate is at 2%. Well, banks would offer an interest rate a little lower than they could lend to each other. So let's just say it's 1.8%. So notice, if Joe deposits dollars with Bank C, then they would have bank reserves to back up those dollars. You see, basically they're paying 1.8% for these bank reserves that allow them to create additional loans in the real economy and make even more than 2%. Or if they've got no loans to create, they could just lend overnight to each other at 2% and pocket the spread. You see, so let's think this through just to make sure that we're all on the same page. If Bank C needs bank reserves, they can either get it from another bank at 2%, or they can get it by Joe making a deposit there and only have to pay 1.8%. So there'd be a lot of competition between banks to get these deposits because they're actually a cheaper way of increasing their balance sheet capacity so they could create more loans, and that's where they used to make the big money. But because there was so much competition, what would happen is the delta between the Fed funds rate and what you were getting in a checking deposit account would basically stay the same. So if it starts at 2%, it's down at 1.8%. Let's say the Fed funds rate goes up to 5%. Well, that would increase this top number, but the delta between the two would pretty much stay the same. So if Fed funds goes from 2% to 5%, and if the interest rate that you are being paid to hold your money with the bank is at 1.8, if Fed funds goes to 5, then most likely the rate of interest you are being paid would go up to maybe 4.8%. So the main point that I really need you to get your head around for the rest of this video is if Fed funds rate goes up, so would the amount that the banks were paying you back in the good old days. So what this would mean is in order for the banks to get a return on their assets, they would actually have to create loans. Imagine that. But today, it's completely different. And today, I mean post-GFC. Because what Ben Bernanke came in and did is he said, hey, I want to do quantitative easing. Well, how does that make the system structurally different? This is what Joseph Wang was pointing out in his blog post. Let's think this through. So now what the Fed did is instead of buying one treasury and inserting maybe another bank reserve, let's say this treasury represents $1 billion. So they bought $1 billion worth of treasuries and they added $1 billion worth of bank reserves. That's what brought the overnight Fed funds rate to 2%. But now they can't pay any attention to what's going on with the Fed funds rate because they need to do $120 billion worth of QE every single month, regardless of what the interest rate is that banks are charging one another. So because they're doing so much quantitative easing, because they're buying so many treasuries and printing up so many bank reserves, their balance sheet has gone from $800 billion all the way up to over $8 trillion. That means there are a massive amount of bank reserves in the system. There's so many bank reserves that the interest rate they would charge each other would never, ever get above 0. So what happens if Ben Bernanke wants interest rates at 2%? Well, along comes something called IOR. Back in the day, it was interest on excess reserve, so IOER. But as you guys know, in March of 2020, they got rid of reserve requirements entirely for these big banks. So now it's just IOR, interest on reserves. Bernanke goes to all the banks and he says, I will pay you 2% for holding your reserves at the Fed. So if you're a bank, you're not going to lend under a 2% rate because you could get a risk-free rate by just parking your quote-unquote cash at the Federal Reserve. But let's take it one more step. What incentive structure is created for the banks who used to pay their customers for the deposits they held at Wells Fargo, B of A, or Chase Bank. Well, now they don't need their deposits because they are flush. They are drowning in bank reserves. They've got way too much balance sheet capacity and not enough people to lend to. So the reserves are no longer their problem. They don't care about those. They've got way too many. So they just tell the average Joe, who has become the average pissed off Joe, and you can understand why, because they're saying, we're just going to pay you 0% or maybe a couple basis points. And I'm sure you guys have noticed this with your checking accounts that you have. You're barely paid any interest whatsoever, regardless of what happens to the Fed funds rate. Editor, go ahead and throw up a chart that I took from Joseph Wang's blog post. And we can see that even a couple years ago, when Jerome Powell was increasing interest rates and he got them all the way up to 2.25 or maybe even 2.5%, what happened to the amount of interest that banks were paying the depositors? It pretty much stayed flat. So that chart was a perfect illustration of the new system that we're in right now. Just for review, remember, when Fed funds went up before, so would the amount of interest they were paying the average Joe. But now, Fed funds can go up from 2% to, let's say, 5%, 6%, 8%. And the amount that the banks will pay the average Joe still will remain at 0. So what happens when the banks are being paid 4, 5, 6%, but they're only having to pay Joe 3 basis points? That means every single increase, every single rate hike means more profit for the banksters. Step number 2, the amount of dollars explodes higher. Check out this chart. This is household checking deposits. And you guys know from watching my videos, I'm always talking about the assets, the dollars on the non-bank entity's balance sheet in the real economy. And I always use that over and over and over again. The non-bank entities in the real economy. So what I'm talking about, households, the average Joe and Jane. How many dollars do they have on their balance sheet? And another way to look at that is how many dollars are liabilities on the balance sheets of the commercial banking system. So here's a chart going back to 2000 all the way to 2021. On the left, we go from $0 up to 3,000 billion, or some of you would prefer 3 trillion. And I can't go high enough on my chart. So the amount of dollars held by households in their checking deposit accounts starts around 400 billion, pretty much flatline, goes up a little bit after the GFC, then kind of bounces back and forth. We got up to a point around 1.2 trillion at the end of 2019. But when we had the stimmy checks and the PPP loans go out, this number goes parabolic. Look at this. The amount of dollars that are in the checking deposits of households in the United States goes from 1.2 trillion up to 3.6 trillion. And keep in mind, this has happened within the span of about 6 months. So it's no surprise whatsoever that we've had significant amounts of consumer price inflation and labor shortages. Oh, but wait, there is more. Let's go back to this diagram that we used in step number 1. I changed it up a little bit. Now let's say instead of IOR, the amount of money that Jerome Powell in this case is paying the banks to hold their reserves at the Federal Reserve, has gone from 2% up to 8%. Remember in this video, we're trying to think through this paradigm shift where Joseph Wang is arguing that higher interest rates, higher Fed funds, or higher IOER could actually produce inflation. Very counterintuitive, because most people would think that higher interest rates would decrease the rate of inflation, if not create deflation where prices are going down. So if Jerome Powell in this case, is pay, or maybe Lael Brainerd coming up next. But if we'll say she is paying the banks 8% instead of 2%, that means that there's more reserves going to the banks. They're being paid these bank reserves denominated in dollars. That's how they're getting the additional interest. So there's nothing the Fed is buying from them. They're just basically giving them free money. So if the balance sheet starts from this standpoint, this is going back to step number 1. If Lael Brainerd is paying those banks an increased rate of interest, well, now they're just making more and more and more profit. Now that we understand that, let's think through what they could do with this profit. Well, the first thing is they could go into the market and buy assets such as treasuries. But remember, we just got done with this big debt ceiling debate, and although they kind of kicked the can down the road, the Treasury isn't issuing as many treasuries as they issued in 2020. So there's not as many treasuries being auctioned off by Janet Yellen. So that means a lower supply of these treasuries. So if the banks have all this additional purchasing power, well, they would have to most likely go to non-bank entities in the real economy to buy the treasuries that are on their balance sheet because Janet Yellen isn't producing the same amount of supply. But if a bank buys treasuries from a non-bank entity in the real economy, it's much, much different than if a bank buys treasuries from a bank or from Janet Yellen directly. Let me explain. Here we've got a little picture diagram bank. We've got two balance sheets. The first one on the left is where we start. So we start with this bank having bank reserves as assets and dollars as liabilities, or customer deposits, better said. And then we've got the average Joe. His balance sheet starts off asset side. He's got some dollars that are liabilities of the bank. And then let's say he's got those treasuries the bank wants to buy with all the extra money they're getting from Lael Brainerd if the Fed funds rate, or IOER, is raised from 2% to 8%. I want to make sure you guys are following along with this example. So the bank goes to the average Joe, says, we'll buy those from you. But what does the bank do? How does it buy those treasuries from the average Joe? Well, it credits Joe's account with more dollars. So now the asset side of Joe's balance sheet, instead of having dollars in treasuries, just has more dollars. And then those treasuries go onto the asset side of the bank's balance sheet, and they have increased their liabilities because now they have more dollar-denominated liabilities that they owe the average Joe. So what just happened by the bank buying those treasuries from the average Joe? It's created more dollars that are on the asset side of the balance sheets of the non-bank entities in the real economy. A simple way of saying this is after the bank buys the treasuries from the average Joe, there is mo money, mo money, mo money, mo money, mo money, mo money. Going back to my favorite comedy show, In Living Color. But there is mo money, mo money, mo money circulating in the real economy, chasing goods and services. But the story doesn't end there. A lot of you are saying, well, George, they might not buy assets with all of their additional dollars. They might lend money into existence. They might create more loans. And you would be right. But what happens when a bank creates more loans in the real economy? As you guys know from watching my videos, it also increases the amount of dollars circulating in the real economy. It goes right back to this. I'm not going to say it again, but editor, go ahead and put up the GIF. More money, more money, more money. Everyone loves it. That thing can never get old. But the bottom line is it creates more dollars circulating in the real economy, chasing goods and services, and this puts upward pressure on consumer prices. But let's not forget what we learned in step number 1. Prior to the GFC, when we had more of a free market, let's say, in banking, if the Fed funds rate went up, so did the amount the banks would have to pay the depositors. Another way to think about this is if they're making more interest on the asset side of their balance sheet, they would also have to pay out more expenses on the liability side. But now we've had that paradigm shift. We have a new system. The financial plumbing is much different now than it was prior to the GFC, in the sense that if the Fed funds rate goes up, in this case to 8%, this doesn't increase the amount that the banks pay depositors because there's no competition for those deposits in the first place. So using the examples in this video, the spread used to be 20 basis points, but now it's 8%. Well, if the spread on lending is 8%, think about how much more risk the banks would be willing to accept because they're making way more profit on each loan. So their lending standards decrease, which could result in more bank lending. In other words, result in more dollars being created that are on the balance sheets of non-bank entities in the real economy chasing goods and services. This would exacerbate the inflationary fuel that was poured on the fire by increasing interest rates in the first place. When Ben Bernanke changed the plumbing of the financial system, he never could have dreamed that it would create this environment where increasing interest rates could actually cause inflation. But this is a perfect example of the unintended consequences that are created by the central planners at the Fed and the government. Step number 3. Unfortunately, the central planners' economic distortions don't stop at higher rates of inflation. Editor, let's cut to the internet. And we're back at Joseph Wang's blog, The Fed Guy, which I cannot recommend enough. And he points out that this new change that we saw with Bernanke when he introduced IOR and did all this quantitative easing, he fundamentally changed the plumbing of the financial system. And with this new dynamic, it suggests rate hikes lead to a flatter yield curve, lower nominal rates, and potentially higher rates of inflation through increased credit creation. And this is exactly what we talked about in step number 2, where the banks buy securities from non-bank entities in the real economy. He concludes the blog post by saying the primary impact of Fed hikes will likely be through the financial channel. Every hike reduces the market value of fixed income investments, with the losses transmitted more broadly through the often leveraged portfolio of the investors. So if you didn't get that last part, basically what he's saying is if the Fed increases interest rates, we'll likely see higher rates of inflation. And I'd like to point out quickly that the Fed no longer will have a tool to fight higher and higher inflation. And this could mean that it spirals out of control. But he's saying, in addition to this, the stock market could crash. And I'm going to explain that momentarily. And we could also see a flatter yield curve than we otherwise would have. So let's go down to this chart. And this is a yield curve. I just drew this myself. So these aren't actual interest rates. I'm just using this as an example. We start here with a 3-month T-bill. We go all the way to a 30-year Treasury. On the left, we go from 0% up to 8%. Now, for this example, let's just assume that Lael Brainerd increases IOER from basically 0% up to 4%. So this is the yield curve we have now, approximately. The rates start pretty much at 0, go all the way out to a year, then go up slightly to, on the 30-year, they're maybe a little over 2%. I haven't checked them lately. But if she increases rates up to 4%, then the 3-month, the 1-year are right around that mark. But then the 5-year, 10-year, 30-year would go up pretty dramatically if we had a normal free market environment, which we do not. Joseph Wang's theory is because the plumbing of the entire financial system has changed Instead of seeing this steepening yield curve, what we now could find is that the yield curve is more flat. So the rates do go up on the short end, but because of the dynamic we were talking about in step number 2, where banks have all this additional cash and they go out and buy treasuries because they're getting a few more basis points than the reserves they have parked at the Fed. So this increases the demand at the long end of the curve. I think the short end of the curve, the demand's always going to be there because of the repo market and things that we talk about in the rest of my videos. I won't go down that rabbit hole. But it increases the demand, which would bring down rates, because increased demand raises prices, which means the yield goes down. So although rates would increase, what Joseph is saying is that we most likely would have a flatter yield curve than we otherwise would if conditions were normal. In other words, we had a free market in interest rates and in banking. Now let's move over to Joseph's theory on why stocks could crash. The majority of portfolios out there, and some giant pools of money with these huge hedge funds, they employ a strategy called risk parity. So insert this guy, Responsible Ray. And everyone believes that Ray is the best hedge fund manager out there. So he has tons and tons of AUM, assets under management. So what he'll do is he'll go out there and do a 60-40 split. And now, of course, the actual percentages are different, but this is the way most people set up their portfolio, and it's the way Responsible Ray sets up his portfolio as well, because that's the way to keep your money safe, or so he says. So in this example, we'll assume we got 60% bonds, 40% stocks, and let's remember that these bonds don't yield that much at all. So Responsible Ray is going to buy a lot of these bonds using leverage, because if he can get just a 1% rate, if he can use all of this leverage and buy more and more bonds with the same amount of cash out of pocket, he can actually increase his yield. But what happens if Lael Brainerd raises interest rates? Well, if rates go up, that means prices of bonds go down. So Responsible Ray could be put into a position where he even gets a margin call on some of these treasuries he owns with leverage. And then he has to sell anything that's liquid. Well, he most likely won't sell the bonds. So what will he sell? The stocks. This puts downward pressure on the stock market. Additionally, if rates go up, historically, the PE ratios go down because the expected profits for corporations decrease in the future. So this would be another headwind for the stock market. But it's not all bad news for those of you who own stocks. I'd like to point out that Biden just nominated, I don't know if she's hired yet or not, we'll have to see, but her name is Saleh Amarova. And I'm sure I'm mispronouncing this, so I apologize, Miss Amarova. And what makes her unique is not only is she the first woman that has been nominated to this position, but she's also the first woman of color, which is very important to the politicians today because they do not like to hire people based on merit. They want to get the right person in the job to pander to their constituents. So instead of judging someone based on their abilities, oh, no, that's old school thinking. Now we need to judge someone based on their sex and their skin color, because we know throughout history that approach has worked very, very well. But for the stock investors, you have to look at Amarova and not only get over the fact that the administration is pushing all these things that just don't matter, but you have to look at her ideas. She is a proponent of a central bank digital currency, something I've talked about on this channel a lot. Additionally, she argues for the Fed being able to come in and buy stocks so they could raise the stock market to whatever level the central planners deemed appropriate. So if all the economic distortions that we've gone over in this video are just a result of Ben Bernanke moving from kind of a market-based system where banks were lending to one another to something called IOER in quantitative easing, just think the amount of distortions that would be created by Ms. Omarova in pushing for the Fed to come in and actually buy stocks to elevate the stock market to whatever level they, the central planners, deem appropriate. This would not only create unimaginable unintended consequences, but it would also create malinvestment, a misallocation of resources that over time would lower the standard of living for the entire society. It goes back to that saying, if you hire people like this and go woke, you will definitely go broke. The problem is now we're not referring to a single business or corporation. We're referring to the entire U.S. economy. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.